Hey guys, it's May from Markets with May, and in this episode, we're going to talk about crypto blowups, under collateralization, or the multiplier effect. Now, I reviewed a lot of white papers, and I've also listened to a lot of the talking heads as they've discussed the under collateralization of some of the different coins that have blown up pretty aggressively. And while there is definitely some truth to that, it is a massive underspecification and oversimplification of what's happened. Now, in fairness to those that report on the crypto industry, are working hard to relaunch tokens, and are trying to get investors to feel calm and confident in their crypto investments in really cool projects, sometimes an oversimplification is what is needed because people don't want all the gory details. But since we all saw a bunch of coins go from several $billion to zero over the course of a couple of days, and we all kind of know that that can't be explained by collateral alone, I'm sure there are many investors and folks that are actively relaunching and working on these coins that wouldn't mind having a longer discussion about what precisely happened. And in that regard, I think it's really important to know a bit more about what precisely is the multiplier effect. Now, I don't want to pick on any one coin because, quite frankly, what I think what these founders are doing is really innovative. Also, I don't work on the inside, so I don't know everything in and out. What I do want to do is present 4 areas for discussion that can be helpful whether you're an investor doing due diligence or whether you work at a token and you want to just make sure that these things are not a problem in your token. First, I want to talk about token distribution as relates to the multiplier effect and GDP. Second, Singaporean dollar. If you have not spent time trying to understand it, you kind of need to, especially as relates to the first point of distribution. Third, I want to talk about the multiplier effect beyond M3. Now, if you're an economist, this is going to be a little bit controversial, but quite frankly, you don't get the speed and velocity of a collapse without something happening beyond M3. And finally, I'll just close it out with some additional comments related to these 3 topics. Before we get into that, please hit the like button down below and the subscribe button. Past performance is not indicative of future returns, and in no way am I suggesting you buy or sell any crypto. Now let's get into collateral, the multiplier effect, and how you kind of need to understand those things in crypto. Now, the first thing I want to talk about is the distribution of a coin. And it may seem like the distribution of coin is just fake money being passed around, but in fact, what you really do start to look at as an investor is what type of project is happening on top of the coin. How does that invigorate economic growth? So it turns out that for any coin, some component of why you're distributing should always be related to the economics that is growing around the token itself. It turns out this is true whether it's crypto or whether it's an emerging market currency. The gross domestic product or the total growth of the economy is incredibly relevant to whether or not any currency, crypto or otherwise, is over or undervalued. Now, distribution of a token or any currency based on GDP growth, that's fair and square, and we are going to talk about how that relates to some idea of intrinsic value within the crypto space, but it's true as well of the fiat currency space. If you've got a country with a ton of GDP growth, then it totally makes sense the currency itself would appreciate. And then I want to talk about the multiplier effect, because the multiplier effect is oftentimes the actual distribution mechanism that is giving out currency. And that can be either via some kind of centralized area within a token that's just giving it out, or it can be some other institution that sits on top as its own project, distributing out tokens and looking a lot like a bank half the time. Nonetheless, the multiplier effect is an important mechanism that sits within the distribution of any coin. Now, one of the misgivings about the multiplier effect is that it 100% causes speculative inflation or a bad format of inflation, and that's simply not true. Now, this is something that sits within the newest areas of modern monetary policy and is something that our US Fed chairman sits there and describes and just gets screamed at by congressmen over and over again as if he literally didn't just address the question. So it's not surprising to me that this would be misunderstood. Now, the reason I think it's often ignored is because it requires a fairly meaningful understanding of what happened with the Sing dollar, the Singaporean dollar, and the renminbi, the RMB Chinese yuan. And these 2 currencies really weren't meaningfully in existence before the 70s. Now let's talk about the Singaporean dollar. And I'm just going to say to all the FX traders and the Singaporeans who might feel like I'm shortchanging this section, comment below. I'll do more videos on it, but for now, I'm just trying to get a little appetizer for people to learn about this, hit the highlights, and give them a shot to try to understand why the multiplier effect, and specifically Singapore as a case study, is something you have to better understand and research. Now, a lot of people will say that GDP growth is the only component that is intrinsic value and everything else must be speculation inflation. And I don't know that that's a quite fair depiction, and that's why Singapore is so impressive. If I were to just use the renminbi, then you would say, no, May, you're totally in the wrong. Look at all those rare earth materials. Look at the fact they've got this huge population. You can't say that because it's just GDP growth, which I think you underspecified, but whatever. With Singapore, it's going to be less ambiguous. That country has very limited to no raw materials because of the nature of how it's spun out of Malaysia in '65. It's a small country, but it somehow made it to reserve currency status. You got to actually investigate there. Now, what Lee Kuan Yew did in the late 60s, given the cards he was dealt, was he just grew the financial system and made it very strong and well regulated. And at first, I think the ambition was really just that ASEAN region. Hong Kong had its own British rulership, and it was kind of a seat within the region in its own right. That said, if you think about it, from 70 to 90, most of the contract with the British had already come to pass. The desire for Hong Kong citizens to diversify their capital into other areas made Singapore, which demonstrated over the course of decades, 1967 from the initiation of its currency to the 80s, that it might be a place for stable currency if you wanted to kind of move it from Hong Kong. At the same time, because Singapore did have a lot of Chinese diaspora that lived there, there was real reasons why trade just made sense between Singapore, China, and then Macau and Hong Kong. Hence, it came to pass as we got closer and closer to the changeover of Hong Kong and Macau, Hong Kong in '97, Macau in '99, and the rise of China through the era of Deng Xiaoping, that a lot of folks started to increase their wealth due to GDP growth of China, but the money found its way to Singapore through the Chinese, Hong Kong, Macanese, and Singaporean citizens that were just trading with each other all throughout the region. Now, I encourage you to take a look at old pictures of Singapore from the 2000 period. It looked nothing like that in 2000. All of this is a testament to precisely how Singapore's economic organizations, everything from GIC to the Singapore Economic Development Bank, what they did to grow their economy. And at the same time, if you look at GDP numbers, that type of growth cannot be explained just by GDP growth in Singapore. Singapore continued to benefit from 2000 to the current period in the fact that China does not want to float its currency. And as a result, Singapore becomes a really good solution for the Chinese diaspora and Chinese mainlanders as a way to manage their mix of wealth. Now, how does this relate to crypto? Well, it relates to crypto because it indicates very clearly that GDP growth alone isn't the only thing that gives a currency its value in the growth stages. That if the currency itself is superior in some way and allows people to transact, that alone has its own value. And in fairness, Singapore isn't the only example of this. I think it's just the most visual and obvious. Even with the US dollar, you can use several specific incidences to demonstrate very clearly the utility of the US dollar. Now, how does this relate to crypto? Well, it implies that if the currency itself has utility, then it can actually have intrinsic value that has nothing to do with the specific projects on that currency's GDP growth. And this becomes very important later when we'll talk about intrinsic value. But for now, just realize that some portion of the growth of a currency is not inflationary. It's actually people wanting to transact with that currency because it has an intrinsic benefit of some sort. Now, I want to mention that Singapore isn't the only currency that has this attribute. All of the fiat currencies essentially have this attribute. It's just that Singapore, which did not exist before 1967, was able to do it as, at the time, an emerging market, then become a developed market, and now be a fiat currency. That's why I think it's such a poignant and important example for all of us that are hoping to learn a bit more about cryptocurrency. I'm going to talk about the multiplier effect. I'm just going to tell you, I'm not going to talk about this the same way as your college professor does. Your average college professor is going to say M1, M2, M3, and then they're going to talk about time deposits and CDs that have longer duration to it at the very best. And I've always thought, since I realized what's actually happening from working in the field for a long time, that boy, this kind of a little abbreviated. See, a lot of times the way this is taught is as if really monetary policy ends at a bank and the products that it produces. But it really abbreviates the financial products that are happening and how precisely the multiplier effect expands the economy, and that's through debt. Now, when we talk about collateral and the idea that maybe the crypto folks that blew up the most aggressively didn't have enough collateral, that's a really fast treatment of what precisely are the instruments that constitute debt. But the economy doesn't expand and then massively deflate because of M1, M2, and M3, which are such babies and have massive time potentiality to create solutions to, and really don't even have that much risk, to be honest, relative to other things. What I then want to talk about with you is what does do that. And that's essentially the concept of liquidity and leverage, and that's where collateral does actually matter. Now, there are really three types of leverage that exist in any financial system, and we usually only talk about one, but in fact, all three are relevant and all three have massive impacts on the multiplier effect. The first type of leverage is what I'm going to call balance sheet leverage. The second type of leverage is the leverage that comes from a fractional reserve system. Here in the US, we monitor that and manage that through a number of organizations. It's not just the Fed. The third type of leverage is margin leverage. Now, in each of these three different types of leverage, liquidity is massively increased, and that's a good thing in an upward market, but it also contracts in very predictable ways in a collapsing market. And it's for that reason that anyone that's going to talk about a collateral issue really should specify which one of these three issues it was, or if it was more than one. Now, each of these has a very specific look and feel when it collapses, so I have my guess on which one it is. But if you want to learn more about that, a great book that was written, I think right around the time of the 2008 crisis, is Liquidity Risk Measurement and Management Practitioner's Guide. I'll put the link below so you can have a look. It's really a great reference guide. Now, the first type of leverage is balance sheet leverage. It creates a certain amount of liquidity. And this is basically when an individual or a company borrows money. It has to do with how much debt they have relative to how much assets, okay? This is very simple stuff, nothing really crazy on the leverage. The bank's gonna give you so much money for how much you took out. And you're gonna pay it back according to the timing that is on that debt. So it could be a month, 2 months, whatever it is, once a quarter, once a year, whatever are the terms of the loan. Now, blowups that we've seen that relate to this, so you get a sense for what it feels like, might be Evergrande, okay? That company has been potentially in default for some time, but as you can see, the government of China is slowly deflating that piece of leverage nice and slow and trying to manage its impact onto the Chinese economy. Now, for the first type of leverage with cryptocurrency, this would imply that the individual projects, perhaps, that were on there didn't hold enough capital in custody, or that the underlying currency itself wasn't holding any collateral relative to what it thought it had to pay out. And that's a little bit awkward given how I read some of the white papers, but possibly. So this is an area that all of the cryptos that really collapsed should take a look at. But my suspicion is this isn't the part that allowed them to collapse so rapidly. Now, the second type of leverage comes from the fact that banks exist, period. And that is because for most nations, most banks are in a fractional reserve system, meaning the bank only holds a fraction of the total capital that it's lending out or doing activities with. Now, we used to do this one way before 2008, and then we did a bunch of additional things after 2008. But the banking system in the US typically holds about 8% of capital by requirement, and then each of the banks, depending on what's going on, then holds a different amount. Now, it's not just as simple as hold 8% and we're all good. There's actually quite a lot of complexity to this. There's the FDIC insurance. There's the fact that we make larger banks hold more than smaller banks. If you want to know more on that, just have a listen to Jamie Dimon's conference call from this last quarter. He's livid over it. And then there's the bank governance itself. A lot of them will just hold more capital if they're a little worried about the economy and what's going on. Additionally, there's the types of capital that the U.S. system is willing to allow a given bank to do versus another country. That stuff is fairly complicated in the sense that there's a lot of rules, but not complicated from the sense that once you learn them, it's really straightforward what's going on. Now, issues with traditional banking leverage being a problem look a whole lot like 2008. And in this regard, you'll see a series of smaller bank collapses. So you'll see a bunch of small savings and loans banks have problems and then they have to be worked out. And then you might see some mid-sized banks start to have issues. See something like Washington Mutual have to get purchased by Bank of America and then collapse Lehman, et cetera, because a deal could not be worked out. Now, these kinds of issues could be related to what we saw, and you would see like a tail of slows decline, and then whoosh, when there's a particular player that just collapses. Now, the third type of leverage that you can take is called margin leverage, and margin leverage happens whenever you got derivative instruments. And in some cases, it's controlled because people are in a cash account, but in other cases, they're in a margin account. The thing with margin leverage is that margin leverage is the fastest of all fast triggers out there because settlement happens at end of day. If you're confused at what this looks like, I would recommend this wonderful Eddie Murphy movie called Trading Places, and that one will explain it to you right away. Now, margin leverage can be very unfair because margin leverage is all about where did the marginal buyer take it to and what was your account at the time it decided to take it to there. Oftentimes, margin leverage will be divorced from intrinsic value in any way, shape, or form. It's just really going to be accentuating the time component of leverage. In other words, the first type of leverage, balance sheet leverage, you pay your debt quarterly, monthly, depending on what type of loan it is. Maybe you pay it annually. The second type of leverage, there's still a possibility once we know there's an issue in liquidity and leverage for someone to step in. In the case of most currencies, it's going to be the central bank or Fed or Treasury. In the case of crypto, it could be a big whale that is just very positively disposed to your currency. There's still a possibility for someone to step in and recapitalize. Case of margin leverage, man, you're going to have, it's an overnight situation. That's going to look a lot more like, Robinhood. With something like margin leverage, you legit have to have a big, gigantic whale that can come in and not only just come in, but transfer that money overnight because you're going to have to close it out. Now, for those of you that are less familiar with what happened with Robinhood, Robinhood had a margin call and they had to come up with capital the next day. They probably figured out there was a real problem sometime in the middle of the day, but it's not really enough time to come together with what would ultimately be the margin call at the end of the day. So they needed a gigantic whale, and that whale's name was Ken Griffith of Citadel. And he came in with $1 billion, closed it out, and then did a series of things. Nonetheless, if you're a cryptocurrency and you think this might be your issue or a potential issue, realize that these whales not only have to be available, but they have to have the cash in a situation where they can wire it overnight, or else that could be a problem. Now, if any of these things make you feel really nervous about the crypto economy and investing in crypto, then yeah, do a little bit more due diligence. But the fact remains that the nuance between crypto and fiat currency is really weak. I mean, these things are very similar. They have similar weaknesses. And it's really just that one is a little bit younger and emerging. And for whatever reason, as a result of that, happen to have a significant more volatility even than some of the emerging market currencies. And I do want to say that I'm really impressed by the innovation and the people in the industry that are trying to make it better. For all the bad press that talks about the idea that only crooks use crypto, it's a real unfortunate thing because unless you're a fiat currency, there's some real positive use cases to what's going on in crypto. And even if you are a fiat currency, I do think that if you look across the crypto universe and see what they're trying to do and see the types of economy that they're creating, that you could take a page out of Singapore's book. But what I mean is Singapore's open-mindedness that it can benefit from the growth of any economy, be it the fiat physical world or this virtual world that is absolutely creating job growth and creating opportunities for the unbanked and for folks to interact with each other globally. Well, that's all I have prepared for this episode. It would mean a lot to me if you would like this video, subscribe to my channel, and if there was something that you really liked or something you think I missed that maybe you'd like to see me do in another video, comment below. That's always helpful to me. Until next time, good luck in these markets, guys.